Welcome to the Tearsheet Podcast, where we explore financial services together with an eye on technology, innovation, emerging models, and changing expectations. I'm Tearsheet Editor-in-Chief, Zach Miller. Debt consolidation is rested on a promise lenders couldn't always verify. A borrower takes out a HELOC, says they'll pay off their credit cards, and the lender hands over the cash and hopes for the best. Credit bureau data lags by 30 days, and there's not always a mechanism to confirm the debt actually got retired, so a significant share of consolidation borrowers end up reaccumulating balances, leaving lenders with paper that performs worse than expected, and borrowers potentially worse off than before. Figure and Method set out to close that loop. Figure is the largest non-bank HELOC originator in America, a public company on Nasdaq running a two-sided capital marketplace on blockchain rails. And Method is a financial connectivity API that gives lenders real-time access to a borrower's full liability picture and the ability to pay those liabilities off directly at the moment of funding. And together they've rolled out what they're calling verified debt consolidation, a closed-loop system where the lender doesn't hope the debt gets paid. They know it. Today, I'm joined by Mitch Shah, co-founder and COO of Method, and Rod Albuya, who leads AI at Figure and is something of a boomerang. He was at Figure from 2020 to 2022, left, and returned in January to a company that had transformed around him. We talk about what the data actually shows, what happens when this capability travels across Figure's hundreds of white label partners, and whether verified debt consolidation is a premium feature or the future of the category. Thanks for joining us. Here's the show. So, Mitt, who are you and what do you do?
Perfect. Thanks for hosting, Zach. I'm Mitch, one of the co-founders and CEO here at Method, and I oversee go-to-market and operations here at Method.
Welcome to the Tearsheet Podcast. Rod, who are you and what do you do?
I lead AI at Figure, sort of a boomerang. I was here 2020 to 2022, and I returned again in January, and the company has evolved quite a bit. So it's been an exciting re-onboarding.
Welcome to the Tearsheet Podcast. I'm interested to hear about the company, about the boomerang itself and how the company has evolved in the interim. But before we get into what you guys have built together, I'd like to start setting context. Can you describe what the debt consolidation lending problem actually looked like before this and what were lenders flying blind on?
Sounds good. Rod, do you want to take it or I'm happy to?
Sure. I mean, I can, this preceded my return, but I can speak in a generic sense, which is there was no real automation. Like you would apply for funds and people would get funded and then they would have to consolidate themselves manually, which means wait for funds to be dispersed, receive the funds. If you have, let's say, 5 different lenders that you want to pay off, have the experience of going to the lender's site and figuring out how do I pay off with this lender? Do they have a system for it or do I have to send them a check? In some cases, it's very clunky and painful. And in the process, you have the funds sitting in your bank account and then you start using that fund for something else. In some cases, all sorts of things can happen. So that is the prior state, which I think is the case for not just Figure, but for any lender altogether.
Yeah. And just going off of what Rod said, I think, and giving a little macro look, cards are becoming one of the most proliferated products in the country. There are about 600 million credit card accounts outstanding out there. And debt in general is at an all-time high. A U.S. consumer has debts at multiple financial institutions. And I think one of the problems that we were looking to solve as we were kind of building out Method was connecting to this financial account infrastructure in the back end. All the banks, credit unions, lenders across all different loan types, mortgages, auto loans, student loans, is I think what we pulled together. So in the debt consolidation industry, one of the main goals for a consumer is to kind of consolidate debt at a lower APR so they're able to pay off higher APR debts elsewhere. And it's been traditionally hard for a consumer to connect their accounts at other financial institutions into that.
Which makes it hard for the lender to verify whether they actually have paid down that debt, right?
Correct. And then just identifying, paying down that debt, having that account connectivity in a seamless fashion is what we kind of pull together. Paying down the debt is one of them, but also, hey, where's my account at? Is it the Capital One account? What is the balance on that account? Is it a verified? Is it as of today? Is it as of today or is it as of a month ago? Right. And I think getting all those details in place from multiple financial institutions into one place is critical. And I think once you go through the flow, you're able to pay those off and getting that verified payment confirmation back to the lender is also very valuable from the standpoint of borrower health and borrower credit worthiness.
Awesome. So let's walk through what actually happens at the moment of origination now. Can you talk about what Method does that wasn't possible before?
Yeah. So a few things. So at the time of application, what Method kind of allows lenders such as Figure to do is pull together consumer where they have all their debts in real time
Mm-hmm.
and kind of show them what's payable using current networks that's set out there from with respect to card networks, biller networks, ACH, proprietary rails, and kind of make it available to Figure at the time of uh, presenting an offer to the end user and kind of helping them get access to offers that are personalized for them at that point in time for the balances that they're carrying, for the interest rate savings that they can see. So it helps bring all this information to the user at the time when they see an offer. And I think that's what Method comes in and helps solve.
I'd love to talk about some of the recent research that I saw. I guess you guys published that in this collaboration between Figure and Method, there was a 50% lower 60-day delinquency rate, 2x funded conversion for opt-in borrowers, a 21-point average FICO lift in 30 days, and $500 per month in interest savings per borrower. That's pretty significant. I'm kind of curious, Rob, we could start with you. Like, how confident are you that it's the product driving that versus like maybe you guys are just attracting better borrowers with this type of integration with Method?
I mean,
Or
the
maybe it's
bottom
both.
line,
It does have to be binary. Yeah.
I mean, to me, the bottom line is that we're approving people that we couldn't otherwise approve. So there's like you're recalculating DTI on the fly. So you're moving your credit boxes based on actual ground truth that is getting supplied through methods. Like that's a big benefit is people who wouldn't see that $500 decrease on we're of course aggregating, but there are people who are seeing a material monthly benefit that otherwise would have been denied. That's a huge gain that is, otherwise non-existent.
And does this change how you price risk at the origination? Are you offering different terms to borrowers who opt in to direct payoff versus those who don't?
Yes. I mean, that is the fundamental, at least as I understand it, which I'm not on the underwriting team, but that is the main benefit is like you're able to uh, adjust your underwriting criteria based on the DTI. DTI is one of the inputs into an underwriting system. So,
And just going off of what Rod said, I mean, there are two key black boxes that have occurred part of that. And a number of lenders have tried to solve this, the account connectivity infrastructure that is just so opaque and it's so deep and broad kind of in the back end. The two main areas where I think it really, the point hits the home is like able to see if you have cards at these four financial institutions and personal loan at these two financial institutions, whether they are payable at the time of loan origination is very valuable to help compute the DTI that Rod was just discussing. And second is to the ability to see the real-time balances. So say if you racked up your card debt in the last 10 days, 20 days, and being able to see that exactly at that point in time from a verified source helps Figure put a better offer. They would otherwise give you, say, a $10,000 offer and see you are actually in need of $20,000 or $25,000, which you may have racked up over time in the more recent history. And that would kind of be available very seamlessly to Figure at the time of kind of loan offer generation.
yeah, and the whole concept of seamless is becoming more through and through. So if you consider like seamless debt payoff to a more seamless HELOC origination process and the full life cycle of servicing, the whole process becomes less noticeable to the person at the point of origination.
Yeah, we all want sort of invisible payments and lack of seams. I just wanted, before we go on, this is something you're working on with Figure. Is this something you also offer other lenders?
We do. We offer this kind of in a variety of loan products as well. So Figure is kind of the marquee and champion in kind of the HELOC space where they've been growing tremendously and have built an amazing kind of user flow and offer flow as well. But we work with personal loan lenders in the space such as SoFi, Bestag, and also work in kind of the credit card space and a little bit in student loan space as well.
Got it.
And
And are you seeing at least directionally other numbers similar to the lift that Figure is seeing?
So we see a variety of benefits and depending on what the use case tends to be. But yes, I think in terms of asset-backed loans here. It's home equity-backed. There's also auto-backed loans. We are seeing increased offer generation, more users being qualified for a loan as a result of these rails. That absolutely tracks. And in terms of delinquency and loan performance with personal loan lenders and kind of other loan products, we have seen market improvements in terms of how the loans are performing 6-9 months down the road from the time.
By the way, if I may dovetail on that, like this
Please.
benefit
Yeah.
through method, like we're embedded into 380 partners like Credit Karma and Loan Depot and so on. So this benefit is not just for Figure direct to consumer originations, but also for our white label partners as well. So there's like a broad spread of benefits through this engagement.
This
Absolutely.
is
And
part of
that's just, improves our
Please
reach
go
and kind
ahead.
of the number of kind of end users and applicants that we're reaching is pretty massive. And the impact that we're having through the Figure team is pretty sizable.
I wanted to come back to part of the data that you guys released. It also looked like there was a follow-on lending number, like a 50% increase in borrowers returning. And if that's the case, like that's not just a risk story, that's like a customer lifetime value story. So I'm kind of curious how you're thinking about that.
I'm happy to kick it off, and Rod, maybe you can jump in. But
I actually,
yeah,
I was going to say, Zach, you may have information I don't have yet, so I would love to hear about it if you have it, Nick.
Okay, well, let's Mick can share it with us.
Yeah, so specific to, 50% are tied to Figure, but what we've seen more importantly, the users coming back from the standpoint of when they become an existing user, if we see real-time balance, or if they are putting on more liabilities or kind of bills in their ecosystem over time, they're able to draw down upon their existing credit lines as well, or are eligible for line increases over time with other loan products as well. So we've seen this behavior across a number of loan products, but yes, I think the 50% number specific to Figure, that's probably news to me as well.
Okay, I hope I didn't get that one wrong, but we'll check afterwards. Coming back to you, Rod, you mentioned all these hundreds of white label partners, and that they get access to the same level of method capability. I'm kind of curious what kind of implications you feel that has on sort of the entire marketplace.
Well, I mean, I think we summarized it at a high level. So like when we talk about the reduction of payment and the lift in the FICO score, that applies to all of our partners. So we're aggregating across all institutions that we have, which is something like, I don't know, over 70% of our originations come through our white label partners. So that's an aggregate number that we're presenting here.
And maybe to put
And
in perspective, Rod, you may have some context, like what's the loan origination volume increase been over the past couple of years, or how do you kind of see yourselves in the market in the HELOC space, all the innovation Figure's brought to market?
Sure. So we've been growing like year over year, kind of crazy numbers, at least for me, having been around at other kind of bigger, slower plodding companies, like 92% growth year over year. And our loan volume right now is at over 8 billion. So, this is just a growing vector, which I'm still getting a grip on what the implications are again, but it is a benefit that comes through to our partners in this engagement. And then, our full life cycle of servicing and so on. When we talk about securitizing assets, that means that or potentially, I would be speculating that like maybe the weighted average coupon would be lower or so on. So some of these assets become more appealing to our partners on the investment side as well.
yeah, I was going to ask about that because it's a dual-sided marketplace. If this does have an impact on pricing on the securitization side.
I mean, it must, but I'm not an expert on that domain to speak to it. But I would say yes, it does affect our population of assets within our portfolio.
And so when your partners come and sign on to the network, do they automatically get access to this level of the method's capabilities? It's
Yes,
not an
the
opt-in
full
thing.
full life. So like they get our entire white label platform, which is our origination system, and like we really started that for ourselves. We were dog fooding it, so to speak, and then when we start bringing on partners, they're leveraging our entire platform, which includes Method. It's like Method, the blockchain and tokenization of assets and so on, and securitization of systems. Like, so the full life cycle method is a part of this, and they get the entire kit and caboodle with that.
Awesome. Mick, kicking it back to you, I'm curious about the competitive landscape. Who else in the industry is doing this, and if there are other people doing it, how far behind are they? From you guys, and is this basically a trend in the industry? I guess I'm trying to understand how deeply this runs.
Yeah. I mean, direct as a concept has been around in the industry for a while, and I think lenders have seen improved performance with the user's intent to pay their debt at the time of origination, rather than taking that debt in the form of cash to kind of go spend more in the market. So that concept has been around. It's been well tested. It's been well hypothesized. I think the results have been pretty strong. The way it's been built in the industry has been, a lot of it has been in-house, with operations team collecting manual statements from the end user at the time of application, verifying those payoffs, either making phone calls to the financial institution on behalf of the end user, actually paying them on their behalf, or cutting them checks and sending it to the user for them to forward it to their financial institutions. And this generally adds a lot of time in kind of their application flow. It adds about 15 to 20 days just to get the loan processed and booked and originated for the end user. And that's where we've kind of innovated to bring a lot of this digitally connected, fewer manual inputs, fewer errors, and just speeding this up by a factor of 10 to 20x. So in terms of who are competitors, a lot of the internal payment operations teams have kind of built this out. And I think there have been a lot of inefficiencies that we've been able to improve in the market. But there are a number of payment rail providers that are out there that do kind of point solutions to give you either certain payment rails to be able to pay these liabilities off through card network rails or through certain banking rails. And I think they continue to kind of offer these products back to the lenders themselves who build these solutions in-house, which have been kind of dated, and method kind of helps them modernize and bridge that to the 21st century experience.
So do you envision, a few years from now, that every debt consolidation loan, well, not every, or close to every, is verified origination, or is this just still a premium feature for sophisticated lenders?
No, I mean, we see this becoming more commoditized and being part of the industry in general. I think a stat that I heard, not specific to HELOC, but in lending in general, about 70% to 80% of the loan applications for debt consolidation that come in are tied to debt consolidation. And I think what tends to happen is, due to the unavailability of these rails, it's still a very archaic process. But I think there is clearly a market need, a market appetite, and that's why I think lenders have gone out of their way to build some of these solutions in-house as well to be able to serve them. But with a technology like this, it's easier adoption. It could go further into the market with credit unions who want to serve a member directly, kind of at their local credit union as well. So I think this has the potential to help drive adoption into the markets that had previously unable to build these capabilities in-house.
Rod, I want to kick it back to you. You mentioned the boomerang, that you had started at Figure, you went somewhere else, and you came back. I'm curious what that experience has been like. What kind of organization did you find on your way back? How's it evolved? How have you been challenged in that sense?
Sure. I mean, frankly, very challenged. It's essentially a different company coming back. So I'm
After how many years?
So I was with the company between 2020 and 2022, and
Okay.
at that time we were, at least the way I framed it was, we're an originator that tokenizes its assets and making it faster and cheaper to run the life cycle of origination. So, like, what I didn't realize at the time was that was a proof of concept for our white labeling service, which really began. It started in 2021, and now coming back, we're a two-sided marketplace, as you mentioned, which is like loans are originated, and not just necessarily HELOCs, but we have other offerings in DSDR and other things, I think, on the pipeline. But we're originating assets ourselves and through our white label partners. And that's the full life cycle. And then on the other side, we have the capital markets partners. I believe we have about 12 large institutions that we work with. And the transactions are originating on our rails, and they're getting bundled and securitized and sold and owned on our rails as well, which is through the blockchain. So, all of this, the concept of ownership and lien perfection is happening via the blockchain, which is really exciting because it's less buzzwordy. There's an actual practical application here that is materially being used and coming. And then as far as my own onboarding, I used to work on the marketing ML side and kind of getting this direct in front of the customers. And now coming back, I'm on sort of touching many sides, including Figure Connect, which I'm actually getting some grip on. Okay, here's how we are handling the tokenization of assets and the blockchain. And now we're expanding to different asset types and allowing originators to bring on their own assets. So we've expanded into auto and small business to say, look, you can originate things on your own rails. You can still use our platform for securitizing assets and getting them off your balance sheet. And we support that as well. So it is it's become, it was a very slick system, and I'm watching its evolution in real time right now, where we're using some AI plugins to kind of facilitate expanding into new assets. So frankly, it's been a very exciting 6 months beginning in January. And I was excited coming back just because I love the culture of Figure. It's a great company to work at with a lot of smart and scrappy people, but it's been fun kind of seeing how the company has evolved as well.
That's awesome. And it's that move from like direct originator to platform. And that has been, I've been in this business for a long time, before I had this beard and gray hair, but we've seen that a lot over time, moving from, D2C into sort of a B2B business. And I guess I'd like to end the conversation with you, Mitt. Like, are you working with other blockchain companies? Is this a new sort of muscle, flexing for you guys?
Yeah, blockchain, I think, is being adopted in a variety of ways. I think Figure's done a phenomenal job of kind of helping bridge the marketplace providers as well. And we work with companies that are adopting technology in a similar format. But where we are seeing kind of us heading in kind of this next phase as well, we've entered the open banking space with a whole different way of kind of helping consumers connect their accounts and kind of bringing it to life with lenders such as Figure, where we also bring is real-time connectivity for their accounts and able to help them and serve them at the point with the lender that they love to work with, or kind of the financial institution that they love to work with, and being able to kind of give the consumer and the financial institution the visibility to the end user's state at other FIs, and kind of helping them get the right lending products at the right point in time is where we are headed kind of as a business and a company.
I wish you guys the best of luck. Rod, Mitt, thanks for joining us on the Tearsheet podcast today.
Appreciate it. Thanks, Zach. Thanks, Rod.